Guys, there are 20 stocks that I'm absolutely going to buy during the market crash if, and this is the most important part, the price hits the value I need it to hit. Stock number one, Adobe. Guys, I've said this time and again. The only rival to me in my mind for Adobe is Microsoft in the sense of quality software business. Obviously, they're in different metric, different markets, but Adobe is an incredibly high quality business. Now, the stock is down 3% today. It's a bad day in the market. All-time high, $700 back in November of 2021, almost 3 years ago. That's a long time to get an all-time high here. It fell as low as $274, $275 back in September of 2022. That's literally less than 1 year later. It had fallen 70% or so. That's an incredible fall. Just goes to show. In the short run, stocks are a voting machine, and even high quality businesses like Adobe can have their bear markets. Now look at this. One of the metrics I look at, $230 billion market cap, $237 billion enterprise value. That $8 billion difference is essentially their debt. And look at this. They generate over $6 billion a year in free cash flow. They can pay that debt off like that. Now, from a qualitative perspective, anybody who's done any sort of photo editing, Adobe is their go-to. And these guys have done a great job of taking it from CD-ROM to a membership where you go online, subscription-based, and you pay for all the constant updates. It's the future of software. It's awesome. It's incredible. You cannot complain about this. Look at these margins. 88% gross margin. That's higher than Microsoft. Look at these returns on invested capital, 20 to 25%. Incredible, guys. I love they don't pay a dividend. Let's go see what the 8-pillar story is on this company. Man, look at this. Checks all around. Slight shares outstanding. I want to make sure they're buying back shares at a good price, not a high price. High return on invested capital, 5-year cash flow growth, 5-year net income growth. Guys, over 20% of their revenue led to cash flow. That's incredible. And again, look at this debt. They can pay it off in less than 1 year when you factor in all their cash and everything, their net debt. Just a matter of what's about their 5-year PE versus 5-year price of free cash flow. One thing I love, 5-year average free cash flow, $6.3 billion, 5-year net income, 4.8. More free cash flow, significantly more free cash flow than net income. Love it. Company's hitting on all cylinders. Analyst estimates, earnings per share, 18 bucks to 30 bucks, 13, 15, 12% growth. Geez, oh, Pete, guys. And by the way, who the hell's competing with Adobe? I mean, this is what I ask everybody. You might sit there and say, well, what about their PDFs? Okay, great. Yeah, everybody can do PDFs, but what about their Photoshop and all these other tools that all these artists, these photographers, everybody uses? It is hard to get around that. It's hard to compete with that. Revenue growth, double digit, according to analysts. 10, 11, 12, 10, 10. This company just keeps on clipping. Just keeps on clipping. That's what I love about this. Now, let's pull up Stock Analyzer tool and let's see the last time I did Adobe on a 10-year analysis. I did 6, 10, and 14% revenue growth. For profit margin, I did 26, 29, and 32. Free cash flow, I did 38, 40, and 42. Now, keep in mind, I went a little bit higher than their 5 and 10-year average on free cash flow because of that gross margin of 88%. They're going to be able to drive that free cash flow higher with such a big gross margin. That means every dollar they sell, extra, 88 cents goes to profit before paying for overhead and fixed costs. That's an incredible number. Companies like that can really drive their net income and free cash flow much higher. That's why companies like this deserve a premium. And that's why I'm putting in 18, 21, and 24 for the PE and price of free cash flow. And guess what, guys? If somebody said to me, you're wrong here, it should be higher, I wouldn't disagree. And finally, my desired return, 9%. No margin of safety in there, just the market 9 or 10%. What is this thing worth to me today? Hit the analyze button. Boom. I got a low price of $250 to $370 based on earnings and cash flow. High price of $700 to $930. Middle price of $430 to $587. If somebody said to me today they're buying it, I'd be like, yeah, I don't blame you. The question is it cheap enough? I don't know. I will say that as this company falls in price, you'll better believe I'm going to be buying shares as much as I can. Because remember, If it falls in price, that doesn't mean that your stock thesis is wrong. It could be for a million reasons. As you saw the stock go from 700 to 275 in less than 1 year in a bear market. That's going to drive down these prices significantly, and you've got to be ready to act, and you've got to be ready the stock falls even further. That's what a true investor does. Stock number 2, Adobe Jr., Microsoft. Now, obviously, I'm joking because Microsoft is a $3 trillion company, but they have a higher profit margin than Adobe, but a lower gross margin, 70% gross margin versus 35% profit margin. Price to free cash flow, this guy spits out cash. These guys are crushing it. High return on invested capital, just like Adobe, guys. Microsoft is everywhere. I use OneDrive over Google Drive. OneDrive to me is far more superior than Google Drive. Google Drive is a great option. We used it for a long time. I personally think OneDrive is better. This company's at $397 after hitting a high on my birthday of $468 a share just 1 month ago. It is now at $397. Okay, not bad. Year to date, still up 7%. In the last 3 months, down 3%. In the last 1 month, down 15%. Incredible. Let's look at the 8 pillars. Something tells me it's going to look a lot like Adobe, and it does. Check marks, X's here on the valuation. Everything else is a plus. You know what I love? They haven't bought back a ton of shares. Only 2.3%. I'm hoping they're waiting for a bear market because they're so intertwined with Warren Buffett. They know Warren Buffett so well. Hopefully he's telling them, guys, wait until your stock is really, really cheap before you start buying back shares. Because that's what's especially key here. 2 times their 5-year free cash flow is their debt levels. Guys, all you're waiting here for a company like Microsoft is you're waiting for this great company to come at a great price. What's a great price? That's for you to decide. But obviously something higher than your market average of 9 or 10%, but that's what's key here. All right, let's go check out the analyst estimates. Big time growth in EPS, $12 to $21 in the next 4 years. And revenue growth. Guys, how can a $3 trillion company grow this much? That's what's incredible. 15, 14, 14, 15, 12% revenue growth over the next 4 or 5 years. That is incredible. These are why these companies sell for a premium, because they're low capital intensive businesses, which means they don't take a lot of capital expenditures to keep going and grow. And they're highly profitable. These companies are hard to get dirt cheap. The market's got to shift against these companies. The mentality's got to shift against these companies or the market in general. That will happen. You know, just today, we had a 6% drop to start the day on the NASDAQ, and now it's down only 2.5%. Market's volatile. These are the times you take advantage of things like this. If it falls in your price, you go ahead and buy it. So what is your price? I don't know what your price is. You can do that in Stock Analyzer tool yourself. But for me, this is what I assume for Microsoft. I did 6, 9, and 12% revenue growth for the next 10 years. 32, 34, and 36 on profit margin, a lower free cash flow margin, and 20, 23, and 26 on PE and price of free cash flow with my 9% desired return. Again, the big key to Stock Analyzer tool is you putting in your own assumptions. I don't know what you know about Microsoft. You don't know what I know fully about Microsoft. We can't possibly cover that in one video. But what we can do is teach this process of like-minded thinking. Hit the Analyze button. I got a low price of 200 to 240, high price of 500 to 525, middle price of 325 to 350. Now, I have my watch list at 275, not as a buy point, but I'm actually going to increase it to 325 because I want to get notified so I can start doing more research and selling puts at lower prices. That's the reason I use the watch list here. It's not to tell me go buy this. It's to go, Paul, it hit a price, you got to pay more attention. I'm not going to go spend my time breaking my neck over a company that isn't in my buy range yet. I'm going to wait and figure it out later. Based on today's price of $397, and if my middle assumptions occur, I'm going to make about a 6.5% return on Microsoft based on a discounted cash flow model. On the highest assumptions, 12%. So if you think the highest assumptions are conservative, and I'm just being too conservative, you might want to take a look at Microsoft because the numbers today might make sense for you. And this is based on cash flow model, not based on earnings. Stock number 3, the Googly Moogly, 165 a share, hit an all-time high just 3 weeks ago of $193. A $2 trillion company falling that much that quickly. It just shows that markets aren't rational. Your job as an investor is to take advantage of that irrationality, not attaching your value to a company based on what the market price is. That's how you do better than the stock market. You have to be able to buy when the perception versus reality is very different. But Google, guys, they own the top 2 search engines in the world, google.com and youtube.com. Not only that, Google's an advertising business. And you look at the world and you look at how much it's growing economically. There's so much more potential economically in Africa and Asia. In so many areas of the world, they can still increase their ad dollars. They've generated $60 billion in the last year in free cash flow and an average of 57 over the last 5 years with very little debt. 2.05, basically $20 billion in debt that they can pay off in half a year. High returns on invested capital. My guess, it's only going to get better and better and better. Remember when everybody said TikTok was taking over YouTube? How did that go? Guys, YouTube is still the #1 spot for long form content, and Google's the #1 spot where you go to in order to learn about something. Now, guys, before we go further, in order to properly analyze companies, you got to have the right tools. You got to have the right people around you. Because remember, Warren Buffett and Charlie Munger always say you're gonna end up being the people you spend your time with. So if you've noticed, if you go to everythingmoney.com, we only have a limited number of daily spots available for Everything Money community and software. And the reason for that is the software as it exists today currently includes everything we have to offer for stocks, retirement, real estate, and all of these tools. Now, we now have 4 YouTube channels, and behind the scenes, we're making some big changes so we continue to expand. These offers are being separated, and that current offer of everything included is going away very soon. If you remember, if you've been watching us since we started, this whole entire thing was built selfishly for me, so that my team and I could use it to constantly make better decisions in all aspects of my money investing. But as our channel and community have grown immensely since then, it's becoming less about me and more about how I can better serve you and the community members. Now, the good news is we haven't made these changes yet. So if you join today, you'll be grandfathered in for life with all the data and all the tools we've made and every tool we bring in. So again, that means if you sign up today, I can never take this away from you. No matter what we do in our offers in the future, it'll all be there for you. So if you're really serious about making better financial decisions, increasing your returns and sleeping better at night, click on the link in the description below to get access to everything we have to offer before we make our changes. And I'm confident it'll be the best decision you've made all year. Now, for Google, guys, everything looks the same here. The 8 pillars are the same as the other 2 companies. These are why these companies are on my list to own forever. They're great companies, great balance sheets. It's just about waiting for the right time to buy them. Analyst estimates, same thing. Amazing growth, double-digit growth a year. These are the kind of companies that take time to wait for to get the right price because they're such great companies. It's hard to find. The market's got to shift on them. So what is the right price for Google? Well, 10-year analysis, 6, 9, and 12%, 22, 24, and 26 on my profit margin and free cash flow margin, which again, could be low. As they grow, that's probably gonna go higher and higher. 20, 23, and 26 on my PE and price of free cash flow, and my 9% return. We have a low price of 130, high price of 300, middle price of 200. Guys, just to prove how much better the company is, when I did this 3 years ago, I had a low price of 80. As time goes on, the fundamentals get better and better and better. Stock number 4, a rather cute stock, different than the tech we've looked at so far, Syntos Corporation. Here's why I love it. It's not sexy. Who here knows about Syntos? It's a company in Cincinnati, Ohio. They're called the Uniform People. This is a company that is driving the American economy slowly but surely, being the backbone of the American economy. As more employees get in, more and more uniforms are done. They do fire extinguishers. They clean the rugs in places. This company is awesome, and they're so under the radar. So under the radar. All-time high, just last week, of $7.74 per share. Hit a low just in September of $4.75. I mean, let's look at the 8 pillars here. Guys, it's not a tech company, but isn't this funny? Their 5-year PE and 5-year price of free cash flow is actually worse than the 3 tech companies we've looked at so far. Isn't that incredible? This boring company pays a paltry dividend of 0.7%. It's just a great business. of great and simple business that's probably going to be around for a long, long time. Let's see what the analysts are saying for EPS growth. High single digits, low double digits, and revenue growth, high single digits. Nothing sexy. Isn't it weird that they're actually selling at a multiple higher? Now, this is where I think there's a disconnect. This company should not be selling at a multiple higher than Google, Microsoft, and Adobe, because those guys can grow their revenue much faster. Now, look at this. Gross profit margin, 48%. You saw Adobe, 88%. I believe Google's 60% or so, Microsoft 68%. I don't know why this company is selling for such a high premium. In the short run, stocks are a voting machine. Obviously, the market has said, we love this company. So let's go see what the stock analyzer is for this company, because I haven't done it in a while. But this is one of my 33 companies I want to own forever. 10-year analysis. I did 3, 6, and 9% revenue growth, 13, 14, and 15% profit margin. Keep in mind, guys, I'm basing the 14 on the 10-year average, even though the 5-year average is 15. So I could be low here. PE, 16, 19, and 22. Same with price of free cash flow. And my 9% return. I have a low price of 192, high price of 430, middle price of 288. Look how far off we are. 740. If you bought it today based on a discounted cash flow model and my middle assumptions occur, you're going to have a negative return. That includes dividends. So, prime example of boring companies sometimes selling for a massive premium. I just got to be patient and wait. 5th company. I love doing tech. Tech is so fun to me, and I love QuickBooks. QuickBooks has made my life easier. Intuit. Love these guys. Close to its all-time highs of 717. Oh, actually, it's not even close, but recently got to a high of 676 for the 52-week high. But all-time high was November of 2021 at 717. Got pretty low there. How low did it get? 339. Yeah, 339 was the low in the last 3 or 4 years. Okay. They pay about $1 billion dividend every year, $5 billion in free cash. Look at this. Free cash flow, $5 billion, net income 3, 5-year free cash flow, $3.6 billion, net income 2.3. It's all basically based on probably some accounting, depreciation of software, et cetera. So they make more free cash flow than their net income. Intuit, 78% gross margin. Guys, tell me some accounting software. And how many people are going to say, if I ask 100 people, what's some accounting software, how many are going to say QuickBooks? They're going to say QuickGain, but QuickBooks is the one. It's incredible. I love it. It's so easy to use. I even use it for my personal life. I basically treat my personal life like a business with a balance sheet, cash flow statement, et cetera. That's how much I love QuickBooks. So of course I'm enamored with it. So I look at the company. But remember, just because I love it does not mean that I'm going to buy the stock at any price. It just means I have to wait for the right price. That's what's key here. 8 pillars. Oh, wow. They've actually increased their shares outstanding. Ooh, I don't like that. That is not good. That is not good. A lower price of free cash flow than PE ratio. 5-year return on invested capital, 13%. 1 year is only 8%. So not the greatest, but 20% bottom line profit margin. This company's going to be around for a while. That's what I love. Analyst estimates, big time growth in EPS. 15, 19, 11%. Almost doubling their earnings per share in the next 4 years, according to analysts, with double-digit revenue growth. And guess what? As the world becomes more economically independent, more and more businesses start, especially in developing nations, I got to think QuickBooks is going to be there to help take care of all of them. That's what's impressive to me. That's the kind of company you want for a long time. So let's pull up the stock analyzer tool and see. And don't worry, guys, the rest of my companies are coming right up here. I did 5, 8, and 11% revenue growth. Again, could be conservative. 17, 19, and 21 on profit margin. 27, 30, and 32 on free cash flow. PE, 18, 21, and 24. Same with price of free cash flow and a 9% return. Hit the analyze button. I've got a low price of 180, high price of 180 to 300, high price of 450 to 700, middle price of 300 to 460. It's on my watch list at 450. So guys, here's a list of the other companies I hope to own in the future. Meta, Berkshire Hathaway, Apple, Visa, MasterCard, Home Depot, Lowe's, McDonald's, Ferrari, Louis Vuitton, Sherwin-Williams, Otis Elevator Company, Costco, TJ Maxx, Johnson & Johnson, Procter Gamble, and Hershey Corporation, the makers of chocolate. Guys, remember, if you want to see my analysis in all 33 stocks, watch this next video. Thank you very much for your time.